This week in the world of supermicrocomputer, the story is a battleground. The company projects a massive doubling of revenue in a single quarter, yet one of Wall Street's biggest names just initiated coverage with a sell rating, warning of shrinking profits. The stock itself is one of the most bet against on the market, but it saw a sudden 11% surge on news that had nothing to do with the company directly. So is this a company on the verge of a major comeback, or is the recent pressure a sign of more trouble ahead? Welcome to TickerWatch News for Supermicrocomputer, Week 5, 2026. This is the weekly report where this broadcast breaks down the essential news and market performance for the server and storage systems provider. This week, the narrative is all about the clash between explosive growth expectations and serious concerns over profitability. It was a volatile week for Supermicrocomputer stock. After trading in the low $30, the share price saw a significant single-day jump of nearly 11% to close at $32.64, driven by positive news from the broader semiconductor sector. However, the stock gave back some of those gains, with one session closing at $31.42 and another at $30.78. This volatility comes in a week where the broader market was mixed. The S&P 500 ended the week up about 0.3%, while the Nasdaq finished down roughly 0.2%. The stock's recent performance highlights a market struggling to decide on the company's direction ahead of its crucial earnings report. The most significant headline for Supermicro this week was the diverging views from Wall Street analysts. Goldman Sachs initiated coverage with a sell rating and a $26 price target, citing major concerns about the company's shrinking profit margins. Analysts at Mizuho and Bank of America also expressed caution, lowering price targets and pointing to execution risks. This bearish stance is a stark contrast to the broader analyst consensus, which holds a moderate buy rating with an average target price around $45. This deep division among analysts is central to the current story. The second major development is the anticipation building for the company's second quarter fiscal 2026 earnings, scheduled for February 3rd. Supermicro management has guided for revenue to be between $10 billion and $11 billion for the quarter. This would represent a near doubling of revenue from the previous quarter's $5 billion. Hitting this target is critical to proving that a prior revenue miss was a temporary timing issue, not a sign of slowing demand. Finally, Supermicro continues to push its growth strategy. It announced it's expanding its manufacturing and liquid cooling capabilities to support NVIDIA's next-generation Vera Rubin AI platforms. It also formalized its entry into new markets beyond data centers, including client, edge, and consumer AI, with products like the Super AI Station and new AI-optimized PCs. These moves show an ambition to drastically increase its total addressable market, but also bring it into direct competition with established players like Dell and HP. The sentiment surrounding Supermicro is intensely polarized. On one hand, the narrative is bullish on growth, fueled by the insatiable demand for AI infrastructure. The company's stock is one of the most heavily shorted on the market, meaning many are betting against it. This creates a powder keg situation where positive news, like the strong report from chipmaker Taiwan Semiconductor, can trigger a short squeeze in a rapid stock price increase. On the other hand, the bearish sentiment is focused squarely on profitability. Analysts at major banks are warning that Supermicro's pursuit of large deals in a competitive market is leading to margin-dilutive contracts, meaning profitability per sale is shrinking. This concern is compounded by news from last November that a company director sold approximately $1.6 million worth of shares. While insider ownership remains fairly high at about 14%, the analyst warnings and insider selling have created a cautious atmosphere, with many investors waiting for the upcoming earnings to provide a clear direction. From a technical perspective, traders are closely watching the $35 mark, which has acted as a key resistance level for the stock in recent weeks. A decisive break above this level could signal renewed bullish momentum. The stock has been trading below its 20-day moving average, which sits at about $31.86, indicating recent downward pressure before the late-week volatility. Fundamentally, the debate is centered on valuation versus profitability. Bulls point to a valuation that appears cheap for a high-growth AI company with a forward price-to-earnings ratio in the mid-teens and a price-to-sales ratio below 1. This is a significant discount compared to many tech peers. However, theirs are focused on the company's gross margins, which have compressed to 9.5%. This is the core of the land grab strategy debate. Is Supermicro wisely sacrificing short-term profit for long-term market share, or is it in a weak competitive position? What to watch next week? All eyes are on one major catalyst, the company's second quarter earnings report on February 3rd. This will be a critical test of management's projections. The bull case scenario is that Supermicro reports revenue within or above its $10 to $11 billion guidance, showing that its backlog is converting to sales and that demand is as strong as projected. Any sign of stabilizing profit margins would be a significant positive. The bear case would be a miss on revenue, or more importantly, a further significant decline in gross margins and weak guidance for the next quarter. This would validate concerns about profitability and intense competition. Key price levels to monitor will be the support in the low 30s and the resistance at $35. The earnings report will likely determine which of these levels breaks first. Thank you for tuning in to this week's Spotlight. This podcast is for educational and informational purposes only and does not constitute financial advice. Please consult with a financial professional before making any investment decisions. We encourage you to subscribe, leave a review, and share this episode. Join us again next week for more updates.